Good afternoon. Today is Friday, the 14th of January, 2011, and the market's closed here for the week. And we finished right on the highs pretty much here at $129.30. We've gone through one important level of resistance, and it looks like we're heading higher here still for, up towards maybe even 130, 131. As I indicated in a tweet I just put out just a couple minutes ago, I'm getting a lot of emails from people who are adamant that the market is making a top. They've got all kinds of fancy math indicating so. They've got precise numbers where this market has topped out in their mind. But yet we continue to move higher, and that's just the type of pessimism and wall of worry that the market, that a bull market needs to climb. And personally, nothing against any of those people who send me those emails, but I hope you get run over because we're in an uptrend, and if you're on the other side of my trade, I hope you lose because I'm looking long in here, and it doesn't mean I just stay long the whole time. I'm looking for ways to hedge myself and look to, where should I manage risk and get out. But the fact is the market's not giving me any indication. What I'm trying to look for each and every day is low risk entry points, and then just to manage that risk, I'm looking for trends that have paused or refresh, that are about to refresh. Stocks like today, like CRM, even a big stock like this one, CRM has kind of built this little launching pad in here the last week or so, as it's just been holding above this rising 10 and 20-day moving average, built this little flag, and broke some resistance yesterday, pulled back in, and then today was just a beautiful little trend trade in here throughout the afternoon. So, the market is giving us opportunities to buy in spots where there's not a lot of initial risk. Once we get involved in that trade, we have one job, not to look for upside targets and try to pick the top, but to manage risk. We always want to have an idea of where do I think CRM could go. Well, I think that, if it's a valid uptrend, well, it should at least hit this high, and then we're going to get breakout players that maybe buy it above there. The market is making higher highs and higher lows. We're above all these rising moving averages, and I will say what I said on Wednesday with just as much conviction that picking a top is a fool's game. And generally I'm going to delete those emails when people argue with me otherwise. I'm just not interested in hearing it truthfully. I'm only interested in one voice, one message, and that's the message of price action, which continues to be bullish. And I'm not growing more bullish here. A lot of people might look at this, listen to my voice and say, well, listen to how bullish he is. There's the contrary indicator. That's not it at all. I've been bullish for quite a while here, as the market has told us that's the correct thing to do. What I will look for next week to get me, to shake my conviction in the bullish upside, and I would probably start to look at, and I have this week, looked at some of the weekly SPY puts as it looks like maybe they're breaking down. And those losing SPY puts have been financed by the winning trades in some of my long stocks. So I'm not recklessly, wildly bullish. I'm looking at this market and saying, the bigger levels of prior resistance are holding a support. We're still above the rising 5-day moving average. We have clear identifiable levels where the market should hold, and if they break those levels, then we get a little bit more defensive. But when we have stocks breaking out left and right, we have strong advanced decline line today, 1,730 advancers to 1,246 decliners. Then I want to be bullish. I want to be buying stocks. I don't want to be looking for the top because maybe one or two people are short for this year. And that are still short for this year and are making money, but I've been we've been looking at the volume weighted average price since the beginning of the year, and we can look at that. The market has moved nicely higher from there. The average price the S&P 500 has traded at is 127.5. So as long as we remain above that level, the average short position in the S&P 500, there's always stocks that are going to blow up and that sort of thing, but the average short in the S&P 500 is losing money. The average long is making money. So you want to be looking at it. Putting shorts on, you're dealing from a position of weakness, and you're going to come in each day day, looking at a little gap lower, a little bit of sell-off, get excited, and then those little gains quickly evaporate. Next week we'll have. Well, that's the volume weighted average price for this week, 128-ish area, and you can see that when we did pull back a little bit, we had support just above that. But this trend line will be something to look at. I don't think breaking it would be a huge negative thing, but 128.60-ish area, 70-ish area actually, next week will be a level to watch. Below that, 128 is the bigger level, and if we break below 128, then what are the dangers below that? Well, we've got this prior level of resistance as well, just at about 127.80. Now, it doesn't mean the market can't make a quick flush at some point in here, but this market just continues to grind higher, like it did in this other leg back in from September through October. September and October were just grinding higher, and people were looking for the top in there. We got a little sell-off. It came down to the 50-day moving average, regained its footing, and now we're in this other this next move higher. The Nasdaq, for its part, closed at close to what's becoming at this point a 10-year high. When we look at the when we back this up, and the components of the Nasdaq 100 obviously are different than they were close to 10 years ago, but it looks like we're still heading for maybe about 58 or so. And you look at what's leading this market higher. It's the semiconductors. And today, we had Intel actually lose ground, yet the semiconductor index, the SMH, broke out past these levels that we've been looking at. And in this market, the semiconductors have been leading the way. As we know, they broke that uptrend line but consolidated through time rather than price, and the market got back to alignment of an uptrend back in here at about $32.80 as the market regained that its footing in there, and we got back above this little resistance level. This is where this market has really taken off from that 33 level, and here we are up at 34.40. We've exceeded the the prior peak right here. Well, we're actually right at it, 2008 highs. We've exceeded it slightly on that we've closed above it. So we've seen that that this market is moving higher in a stair-step fashion, where these prior levels of support acted as some temporary resistance there. Maybe we'll get a little bit of resistance in here, and you could say that the semis are a little bit overdone, and maybe they digest these gains a little bit next week, but there's no sign of a top in here. Being up is not a topping sign. A topping sign is when the market starts to turn sideways and then roll over. So again, I understand where people are coming from when they say, hey, well, what about the deficit and the the dollar and all this stuff. The market doesn't care right now. When the market cares, it will matter. But right now, the path of least resistance remains higher, and our job as traders and even as investors is to manage risk, to go with the trend and manage risk. Picking a top, if someone does it, then that's terrific. Good for you. But I would bet that you're going to get stopped out a whole bunch of times before you can turn back and say, hey, I picked the top. Anyways, enough of that. We've got financials that are strong. These financials are, on the weekly chart, they've exceeded, as we know, the flash crash highs. They're up toward, closing in on last year's highs and getting above that level. Perhaps we're going to see $18.50, $19 a share on the financials. Bullish action in there still. We're above a rising 10, 20, 50-day moving average. The IYR is holding in nicely here. It's more correcting through time, but has an overall bullish tone to it. And the home builders, everyone, that I see fundamentally generally is writing, and I don't read a lot, so I shouldn't probably say that. Headlines, I should say, about home building are generally negative because I really don't read many articles about them. But they look like they're headed for $20 a share or so on the home builders, and you just can't argue with a breakout past resistance that just continues to rally. Pulls back first to the rising 10-day moving average, pulls back, finds its footing at the rising 20-day moving average, and here we are in an uptrend. In short term, maybe it's overbought. Who knows? I mean, let's look at the short-term levels: 18.20, and then below that 17.95. If you're looking to short for a few pennies, then that's fine. But if you look at what is the potential bigger prize, that potential bigger prize is looking at about the $20 level. Let's see. Explain if you would, please, and then I'll use that. But retailers have they looked like they were turning away a couple times from the highs from 2007. You could also make a case, if you want, that they're making a big bullish cup and handle, and breaking past this 109 level could be something that fuels the retail holders still higher. They're holding a rising 50-day moving average. They find their footing and they move higher. If the retailers break below 104.10 or so, then perhaps we'll see a little bit of profit taking. It's up to a previous level of resistance, but that doesn't mean it can't move higher from here. And shorts who are defending against that level might be forced to buy in above that area. So let's take a look at this weekly chart on the SPY for a minute. Someone was just mentioning a measured move, and I don't know if they were referring to this move, this being A to B right here, and this being B, or I'm sorry, this being B to C. And then you could look at this thing as far as if you draw an exact line there, we can draw this line. We can take the height of this move, so let's just draw an identical line, and we could move that and see if maybe this thing's headed for a measured move indication would be up near 150ish, and why not? The path of least resistance is higher. These levels are potential areas of resistance. This is the next potential level of resistance. It might just cut right through that level, like it has the other potential levels of resistance that people have been looking at. But 145-ish is a bigger level, and then again that measured move. And that's actually Today Trader pointing that out to me, measures out to about 150 or so. Hey, it might look crazy to you, but if you look at price action in the markets and what they're doing, that's what matters most. You can put all these academic research papers about whatever you want. I get some crazy emails with all this high math that I never wanted to learn, and I'll go into the grave not knowing, simply because it can't help. It has not made me one single penny, or hasn't cost me a penny not knowing it, as far as I can see, because the emails keep coming in saying mathematically that's the high, that's the high, that's the high. No, this is the high, that was the high, etc. So I don't mean to go on and on about this. Again, I'm not wildly over the top bullish. The main message is we're in an uptrend, and our job is to manage risk. If the market starts breaking down, I'm going to be looking for good short candidates. I still look for good short candidates. I didn't read his post, but Upside Trader today said something about how it's hard to find shorts. And the headline told me all I needed to know. It's just hard to find good short candidates. The stocks that look like they're breaking down, QLogic, they look like they're breaking down, and then they squeeze those shorts. There was CEDC. I was talking to another trader this week and saying, they're not breaking it here. I bet you they're going to squeeze this thing. And stupid me didn't even buy it, but massive move in there. So anyways, the market's in an uptrend. What's not in an uptrend? Gold's not in an uptrend. It's still really more neutral than anything. It did break a little bit of support in here today, so as I've been talking about for a couple weeks in here, that it's more neutral. That if you're a trader, you probably should be sidelines in cash. If you're an aggressive day trader, maybe you look for some short opportunities, but it's really largely in a range, and I wouldn't be surprised to see it down near 130, but I don't think that's what would break gold. But we'll see. We'll see how it goes. We've got a bigger trend line that comes in with gold as well, right at that 40-week or 200-day moving average. So maybe the gold market's headed for a little bit of pullback. Fine, great. If you're a gold trader, then you should be concerned. But anyways, that's all I'm looking at. And Snoopy's telling me, look at NVIDIA. It's looking like a blow-off top. And I'm going to disagree with you, Snoop. I don't think it looks like a blow-off top. That's what people were saying about DECK. That's what people were saying about EW. I would not be shorting these things. People were calling this a blow-off top. Decker's Outdoor has consolidated nicely, and I'll bet you if next week, if you get this thing up through 82.50, you're going to squeeze a whole nother batch of shorts that are looking for the top in this thing. Like I said, EW was another one. People were saying that's the blow-off top. Well, you know what? You get this thing up through 82 and change. I think they're going to squeeze shorts in there. And NVIDIA blow-off top, I don't see it. I see a huge uptrend that's probably running shorts over. And, picking a top, it's just simply, here it broke out on a weekly time frame. It still has the potential to run. Now, I think it's getting late in the game if you're looking to buy this thing. But, the blow-off top, you would be looking at massive volume here, and we're not seeing that. It's in an uptrend. What do I think about FAS? You missed the pop in the morning. I think you look for the XLF to pull back, and then you get involved. Base your analysis on the XLF. Realistically, where would you have looked to get involved in this long today? And basically right from it's been in an uptrend. It's innocent till proven guilty. But if we look at this, right, look at how the market's moving. It had a correction through time. It had a correction through price. It had a correction through time, and then it's rallied. So we're seeing these rallies that are being digested properly. That is, that resistance becomes support at a key moving average. First, we had again the 10-day moving average, then just above the 20-day moving average is prior resistance holding a support. So what we don't want to do is chase this market after a move like this. Instead, we want to look for the next correction, whether that correction comes through time or through time or by price like here. So again, I don't think you want to be chasing these things. It's about risk management. Risk management is simply job number one. It always has been. It always will be. It's the best tool, that's going to keep you in this game and keep you alive and keep you there for the next day. It is not good risk management to try to pick the top in these markets. Anyways, I'm done. I hope everybody has a great weekend. That's going to do it. We'll talk to you again on Wednesday. Have a great weekend.